Welcome to Who Charted. This is Dan Russo, portfolio manager at Potomac Fund Management, and here with me this week, making his debut appearance on the show as we've gone out and upgraded our on-screen talent, is our new research analyst, Drew Wells. You know the drill here, 6 charts in 6 minutes. Let's get into it.
All right, here we go. This is the S&P 1500 Composite Index. This represents roughly 90% of the investable universe in the U.S. So on the bottom pane here, we have the advanced decline line, which is the number of stocks advancing minus the number of stocks declining. Okay, and something I want to point out here is that we are experiencing a little bit of a breakdown, testing of support right there at the 50-day average. As the index itself comes down to test support, right, it's 50-day average, right? So teamwork makes the dream work. We want to see more stocks participating in the trend as it continues to rise higher. We're seeing a little bit of weakness in breadth within the S&P 1500. That's something that we want to pay attention to. There's no indicator that we take by itself as alone as gospel. So this is something, a little bit of a risk that we're being mindful of. But again, unless price materially breaks down on that index level, then that would be a false signal there on our advanced decline line, but something we're paying attention to.
All right, for me, it's all about the bond market this week. Obviously, Friday was a big down day, day after Thanksgiving. I like to pay attention to what's happening in the bond market there, especially if we think we're at an inflection point or potentially the start of something bigger in the equity market. We would think the 10-year Treasury note would rally, and obviously we rallied. There was a flight to safety on Friday, but what's interesting to me is that rally stopped dead in its tracks at the declining 50-day moving average. Now, we do have a potential false breakdown. We also have a bullish divergence on the RSI, 14-period RSI starting to make a series of higher lows. So if this really is the start of a breakdown in the equity market, I would expect to see 10-year Treasury note rally through those early November highs and continue to keep going. That would obviously send yields lower. Thus far, that's not the case. But for me, this week, the bond market is king in terms of tells for what could potentially be going on in the equity market. So we'll start there with the 10-year Treasury note.
All right, one of the street's most dearly beloved investment factors, low volatility. So these are the stocks within the S&P 500 that have the lowest realized volatility. One thing that you'll see on the top pane here, this is low vol stocks relative to the S&P, and the middle pane is the S&P 500. One of the things that you'll notice is after the sell-off on Friday, the S&P has not been able to get down and test that 50-day moving average yet. On a relative basis, this ratio is moving up and testing a resistance level and its 50-day moving average. One thing that you want to see if you were an equity bull is a continuation of this downtrend into the future, right? So correlation, rolling monthly correlation with S&P 500 low vol and the S&P itself is historically consistently pretty negative, and that makes sense, right? So you see conservative stocks tend to underperform when the market's rallying strong and fast. So we're not there yet. We did not get a breakout in this ratio, even with all the action that happened on Friday. It's something that we're watching that could materially change our view if we do see those developments. But as of now, we're being mindful of it.
All right, try to get a read on what could potentially happen in interest rates. We did a good blog post about this a couple of weeks ago, intermarket analysis. So in that vein, paying attention to the regional banks relative to REITs. If regional banks are outperforming relative to REITs, that's an indication that rates are likely working higher. Banks like higher rates, REITs like lower rates. Right, so we can pay attention to this ratio to get a gauge or confirmation for the move in interest rates, right? You can see that starting in November of last year, the ratio started to rally, so did rates. March of this year, this ratio started to fall. Rates started to pull back in a little bit. And now we're in this choppy consolidation as the 10-year Treasury note butts its head up against that 50-day moving average. We're going to watch this ratio closely. If this breaks down through that support level, the green rectangle, that to me would be an indication that rates are likely moving lower, that Treasury note is going to move higher. We want to pay attention to this ratio here because it could be a leading indicator for risk on, risk off in the marketplace.
Alrighty, small caps. If you have not seen the recent breakout and subsequent failure of small caps, you must have been living under a rock for the past 6 weeks or so. So within small caps, this is small cap low volatility versus the S&P 600 index. The ratio on the top pane, middle pane is small caps, and the bottom pane is your rolling monthly correlation. You'll notice how consistently negative that correlation is throughout time. One of the things that you'll see is much higher lows in this ratio, and we're on the verge of a breakout here, highlighted in that pink area. So it has not happened yet. We do have an upward sloping 50-day moving average right there. It's something that we're being mindful of as the small cap index breaks down from that breakout level, confirming that false breakout. So this is definitely sending a signal of risk off behavior, certainly within small caps. Again, it's a much different picture that we're seeing in large caps. We haven't seen that transferred to large caps yet, but this is a ratio that we're keeping an eye on as far as positioning goes in risks in small caps.
All right, my last chart is high yield relative to treasuries. Stands to reason that if investors are in a risk-taking mood, high yield bonds will outperform treasuries. It just kind of makes sense. And that's largely been the case for over a year. A nice steady uptrend above a rising 200-day moving average. And that 200-day moving average has acted as support to pullbacks. That support gave way in a big way last week, with high yield breaking down relative to treasuries. And what you can see, the bottom of the chart is the 63-period slope starting to roll over as well. Now, it has not gone negative yet. And if we wanted to, we could probably draw a solid support line on the ratio. However, if that 63-day slope goes negative, to me, that is going to be an indication that the intermediate term trend in this ratio has turned down, i.e. cautious, with treasuries outperforming high yield. To me, this would be another scenario where you'd expect to see treasury rates moving lower. So another one of the key indicators that we are keeping an eye on from an intermarket perspective is this high yield versus treasuries ratio that is on the verge of a breakdown.
All right, that does it for Who Charted. Thank you very much for watching my debut appearance here, and we'll see you in the next video. Don't forget to like and subscribe on the video.
All right, everyone. Thank you for taking the time out. We'll see you soon.